Hello and welcome to interest.co.nz. I'm Gareth Vaughan with another of our double shot interviews, and I'm here at the Reserve Bank's Auckland office with the Governor, Adrian Orr. Thanks for your time, Adrian.
Kia ora, Gareth.
Yeah, look, there's a lot on the agenda, so we'll try and get through a few things. But I think probably key issue right now is perhaps bank capital, which doesn't generally get a lot of traction in the media, but is at the moment. So you're obviously proposing some significant changes to the amount of regulatory capital banks need to hold. So I guess if we just kick off by saying, why do New Zealand banks need to hold more capital, and why have you come in at the position you have come in at in terms of how much more they need?
And I want to thank you as well for starting with that, because it's nice to have some light shone on things other than monetary policy around and our prudential regulatory regime. What we're saying to banks is that more capital and better quality capital will improve the soundness and efficiency of the banking sector in New Zealand. So there's no trade-off by making it safer but less efficient. We're saying we are so far short of necessary capital that we can have more without damaging or tending to offset their lending behaviours. And why I say more and better, more in the sense that we have a very small regulatory level of capital, but the actual level of capital banks hold is already well above that. And we're saying, well, why don't we just acknowledge that and also have a bit more capital so that we can reduce the risk of bank failure. Coming back to it is we're trying to calibrate it to society's risk appetite rather than the risk appetite of a particular financial institutions. We know that society's risk appetite is less than a bank's risk appetite, because banks get to privatise their earnings but get to socialise their losses. If they fail, it's us, it's taxpayers, current and all future citizens, who have to pay for that bank failure. So we're trying to get a better balance. More capital means a safer bank, it means a lower risk bank, which means that they will have a better credit rating themselves, and it means that society is in a better, both safer and more efficient position.
Now, there seems to be a bit of surprise in the banking industry at just what you're proposing. Are you surprised that they're surprised?
Yes. I'm disappointed, actually, not surprised, because this is almost a 2-year process that we've been going through and working very closely with the banks. And I think it also comes back a little bit to the conduct and culture that has been going on both within banks and a challenged relationship between the central bank and these people, because we have been saying very loud and clear that we are reviewing this. This is the fourth and final proposition paper. We talked about the numerator, the denominator. We've gone all through this process, and then this is the final part. Also, it is still a submission. This isn't our final decision. You know, they have until May, they plus all New Zealanders, in fact the world, to provide submissions around whether we are calibrating it to the right trade-off of the risk appetite of society as a whole, and then bringing that back into how much capital and what quality of capital would best meet that. So banks themselves, or so far we haven't received submissions, but some commentators have come out with some and some financial experts, purported experts, have come out with some pretty outrageous claims.
Yeah, one of the criticisms thus far has been, there's not enough cost-benefit analysis that's been done by the RBNZ in your consultation paper. How do you respond to that?
Well, I haven't received that criticism myself, so obviously people are talking to you rather than us, and I'm looking forward to seeing the submissions. I've been approached by people who have clearly not read the document, who have clearly reacted through self-interest, and it's different. So, you know, the cost-benefit analysis, what we're saying is that we believe more capital and better quality capital could cost a bank something. And so we're not hiding from that. We think around 20 to 40 basis points additional premium between the cost at which they borrow and lend will be passed on because of them having to raise equity rather than just leveraging debt. So we're not hiding from that. But the wider benefit is that their total risk is lower. their ability to attract equity will be cheaper because the investors will have a lower expected rate of return because they are a safer institution. And then beyond that, the cost to the economy, because we have more capital, safer institutions, our whole credit rating will be better. So when I talk about margin, lending margins, what our interest is the total cost, not the margin. So yes, it may come at some impost to banks, but that is part of the game. Some of the measures and expectations, they've said, well, we're going to pass it on immediately. Well, that tells me that they're operating in a monopoly situation, not a competitive situation. Show me a business that can pass on every cost. They're saying we're going to pass it on only to mortgage holders. Well, what about deposit takers? What about other lenders? Why would that be the case? So, and if you've got more equity, then why wouldn't you have less debt? And so these things have to be properly considered, not just, hearsay, panic and fear.
Now, obviously, this is coming at a time where the economy is slowing a bit, and I think in your consultation paper it does talk about, as you've noted, potential for mortgage rates to go up, deposit rates possibly come down. There's talk of credit rationing perhaps, and even an impact on GDP. So I guess, how conscious are you of the timing of these proposals? The impact on the broader economy?
Very conscious. And by the way, everything you just said shows that we are thinking hard about the benefit cost analysis. And we were providing kind of both simple ways of thinking about it and our estimates of what it would be. We're not trying to hide from that. What we've also been saying is that is about the margin on lending. It's not necessarily about the level of lending rates. The level of lending rates is about what is our risk rating relative to the rest of the world and what is monetary policy doing. So if we see interest rates being too high for our purpose, i.e. some unexpected event happen, we can lower interest rates. Likewise, we can raise interest rates. We set the level of interest rates. They set the margin and their profitability. So that has to be remembered across the country. They talk about their margin, we talk about interest rates as a whole. Banks can choose various paths to meet these requirements if they're done. They can just retain more earnings. We estimated 70% of retained earnings over the next 5 years would get to the capital requirement. They can issue more equity, or they can start pulling their business back. And if they start pulling their business back, there are other businesses that may fill those gaps. There's no shortage of people wanting to grow their balance sheets. Likewise, the bigger end of town, other institutions could issue their own debt. It doesn't always have to go through the banking system. So, there are so many other things that could happen. It's not a hold everything else constant, this will happen.
Now, obviously, it's a consultation process.
Sorry, I must just interrupt you. And also we've said we don't want you to get there tomorrow. If we agree that that's where we're going, we were saying at least over the next 5 years, and we will talk with each of you individually. Because some banks have more work to do than others. A lot of banks are already there. Some are north of the number, in terms of the total capital. So
Can you name any?
Well, if you go onto our website, you can see where each bank's capital is, and you'll see the total capital. So the banking system, I think it's about an average of 14% risk-weighted capital. The bigger banks are around 12. Some banks are a bit north because they've actually had to hold more capital because they haven't been playing the game quite right. And so, it's a mixed story. One of the great benefits, which is an externality of this, will also be that capital and the risk models won't be used, or will be less used as a competitive tool for entry into markets. The risk weights are meant to be about how to allocate across sectors. It's not meant to be about how much capital you hold in total. And we believe that there has been some unjustifiably large differences of capital holdings across banks for the same risks that they're doing. And we're saying, well, we want to see that narrowed, we want to see more competition, and we want to see more capital.
And so that is that's what the changes to the internal models approach is about, is about levelling the playing field. Is that what you're trying to do?
We're saying we want to put a floor on the difference between those who have got standardised models and those who have got the internalised advanced models. Because the advanced models are meant to be about relative allocation, not the absolute level of capital. And that relative allocation, we say, you are the experts, you can allocate in that relative sense. We're not changing that behaviour, but we want to see more capital held. that capital will be used. It doesn't just sit in a tin for a rainy day. Banks can use that capital and they can allocate it according to their models. But what we don't want to see is massive differences, say, for lending to the rural sector, where one bank only keeps 5 cents for every dollar and another bank keeps 10 cents. Same farm, same country. Why is that such a big difference and such a competitive advantage?
Now, in your monetary policy press conference on Wednesday, you talked about returns on equity in New Zealand banks being incredibly strong. I think of the big 4 banks, I think in the last dashboard figures, 3 of them were over 15%. I just wonder, I mean, what you're saying to banks is you want shareholders to, I guess, put more of their own money into the banks. Are you effectively saying to the big 4 banks shareholders that the halcyon days of these great returns out of New Zealand are over?
What we're saying is that, well, what I was saying is that for every risk there should be a reward. And when you look at banking system globally, that reward has been greater than the risk taken. And that happens because banks can take the returns, they don't have to wear all of the losses, because the losses are socialised through bank bailouts and failure management and all of the things that we're still struggling to recover from in the GFC globally. So that reward has been in excess of the risk. We're saying let's better balance that. Let's bring the reward back down to something where that better justifies the risk. So we're doing 2 things at once. We're lowering the risk through more capital, and if investors are struggling to say, well, with lower risk, they should expect to get lower return. And so that's simple. I mean, when I was running the New Zealand Super Fund, we wanted to be rewarded for the risk taken. If we could find excess reward, that was fantastic. Let's go there. But for the banking system as a whole, it's too critical. The fear of failure would create failure, so we're saying let's reduce the risk, and hence expected returns on equity would probably decline. Again, coming back to, I've heard commentators say, well, to maintain that level of return on equity, we'll have to double the margins. I don't know a business in the world where I can say, I want X% return, and now go out and just create it, other than uncompetitive industries.
Now, you mentioned before that it's the proposal is that this is phased in over 5 years and that you've offered to work with banks individually. I mean, obviously, this is a consultation period, so this is a proposal. The final decisions aren't taken. I mean, are you effectively saying that some banks could have more than 5 years to do this?
Yes. I mean, why 5? We plucked that out of the air. That's it's not 4 and it's not 6. We said we want to get there, we want to all agree where we want to get to, and then we can talk about what makes sense getting there. The interesting thing, of course, is that markets are forward-looking, and so some prices may move almost quick. You saw the equity markets on the banks on the announcement of our proposal. Prices shifted quickly. But for us, we want to say, we want to work with you. We want a sound and efficient and profitable financial system, just as you do. Let's work through this properly. The current situation is suboptimal. Let's get to an optimal situation in a way that doesn't kill us on the way there.
Now, I mean, you'll obviously be aware that the banks, especially the bigger ones, have lots of people who are very good at lobbying. Politicians are being asked questions by the media. No doubt the banks are on the phone to them, chatting with them as well. To what extent do you think this is already perhaps becoming a bit of a political football, and what are you getting feedback from politicians on this?
I'm getting feedback with regard to an enormous amount of questions around the process and the outcome we're after. I'm not getting any questions around whose responsibility it is to make these decisions. So it's been bipartisan across. I was at the Financial Expenditure Committee as recent as yesterday, and it was very clear that they are highly interested, highly concerned that we are after the right thing, that we are looking for society's risk preference, but it's our task. And so, that is the wonderful thing about living in a strong institutional society like New Zealand. We can talk openly about the goal we're after and then operationally independently get on and try and achieve that goal. But I do agree with you, the banks globally have been incredibly powerful. The Bank of International Settlements, the original 8% capital, was largely a politically negotiated starting point back in 1983. There's no underlying economics to it. 8 wasn't, it happened to be the level of capital the Japanese banks had at the time.
Now, one other aspect of this is, I guess, in terms of potential newcomers to the industry with higher capital standards. Do you think it's raising the barriers to entry for potential new banks that could come
I think it's actually quite the opposite. I would say the barriers to entry are when you have to hold far more capital than someone else to do the same business. That is a barrier to entry. That is an unfair competitive position. So most small entrants and most small banks that come in are highly capitalised and using standardised models. They aren't using advanced models at low capital rates. So this actually levels the playing field for entry and exit, and it makes the industry have to compete on things other than their risk models. They have to compete on things like long-term service. They have to compete on being smart at allocating capital, compete on whether they do or don't look for the marginal last dollar loan. And it also, reduces the need for a regulator to have to be in their face. A lot of criticism and stuff that's come through from some people who write for you is about we need hundreds of people, we need to be all over their models. Well, all we're doing is being chased further and further down the rabbit hole. I don't know what the optimal allocation of capital is in your bank. I don't have a team that can nickel and dime whether your model is or isn't perfect. I don't want to be the one that says you're holding us up, we should be doing these loans. I'm just saying capital, real capital, simple, transparent, and we will calibrate our response accordingly. Go knock yourselves out.